Assalamualaikum. Welcome to my video tutorial. This time, I will explain to you about how to make simple financial projection. Before we step further, we need to know what are the benefits of making financial projection. For the first benefit, financial projection help us to estimate profit and how much remaining cash in our hands at the end of period. We don't want to use all of our efforts and money in a business but end up to have nothing. And now, the second one, this is mostly what banks really needed. Financial projection help to find out if the business will be able to repay a loan and cost of financing. Cost of financing could be in interest expenses or ujrah expenses for Syariah type of loan that gives fixed amount of payment. And the last but not least, financial projection help us to find out if our proposed business plan is financially feasible. We don't want to if we have a good product and marketing, but we sell it at loss. In some cases, there are companies that sell its products well, but somehow are going to bankruptcy. Next, we will see the outline of simple financial projection. First of all, we need to make assumptions in order to calculate financial projection. Say, sales assumption. It could be selling price and volume assumptions. For a cost assumption, it could be cost of goods sold or COGS. COGS derived from production cost or buying price from supplier in case of reseller, before we put a margin. Other assumptions could be how much investment amount, how much loan, and cost of financing, etc. In making assumptions, we need to forecast the value in the future. For example, if current selling price is $100, next year we predict in our assumptions it will raise 10% to become $110. Don't worry if our assumptions that we made are not exactly the same with the future condition. We are human beings after all, cannot see clearly the future, but at least assumptions that we made are not going too far with real condition. That's why fellow analysts use certain references in making assumptions such as inflation, market condition, etc. It cannot be denied, this is the hardest part in making financial projection. It becomes source of debate among analysts. We surely cannot see the future, but at least we can make reasonable assumptions that are acceptable to several parties. After we have made several assumptions, then we can make cash flow. Basically, there are two things in making cash flow. Those are cash in and cash out. Simple, isn't it? Now, we will look further what cash flow looks like. As I mentioned earlier, talking about cash flow, we simply talk about how much cash in, cash out, and the remaining cash. Next, we will go more detail about it. What does cash in consist of? Cash in consists of all revenue that we get from business, then paid in capital to start the business, and loan if you lend from bank or even from your mother. You have to put it as a cash in. And then for the cash out, usually every money spent, whether it's a production cost or operating cost, including salary, are cash out. Investment to acquire assets in order to start business is also cash out. Dividend that we pay to shareholder is cash out. Also, loan that we repay to bank is cash out, including financing expenses from interest and ujrah is cash out. All of the cash in and cash out will be calculated as a net cash flow at the bottom line. And now, I will give you the detailed example of cash flow outline. As we know, the devil is in the detail. I hope you keep with me, not just pass out to another universe. Say, we are in a grocery business. Cash in could be from sales of our product, paid in capital and loan. And then cash out could be from COGS, operating expenses such as salary, electricity expenses, etc. Also, tax expenses to our beloved government. Furthermore, investment to buy, sell, cash register, and so on is cash out. Dividend to shareholders, including to you if you are the owner, is cash out. And the last, loan repayment, including cost of financing, is also cash out. The remaining cash in and cash out is net cash flow of the company. Remember, this is company's money, not your own pocket money. Several companies, mostly family company, has gone into bankruptcy because they cannot differentiate between company's cash flow with personal cash flow. From earlier, we talked about money going in and out as we receive right away. If we receive or pay the money at the later times, it will raise more questions. What if there are account payables? How will we record it on cash flow? To answer previous questions, we need to explain that account one by one. At first, accounts payable denotes by AP are type of loan that must be repaid in near term, not kind of bank loan that you can repay next year or even more. That's why account payables are short-term liabilities, or we can say current liabilities in a balance sheet. Accounts receivable denotes by AR are our claim to customers because they buy our products but pay later. Receivables become our current asset even though it will become cash only after customers pay to us. Inventories indicate amount of goods that's stored on warehouse, whether it is finished goods or raw materials. Inventories are current asset even though not in the form of cash. In practice, there are more than just those three accounts that categorize as current assets or current liabilities. But at least, knowing the number of those three accounts will be very important to calculate working capital. Now, what is working capital? Working capital represents operating liquidity available to business. The formula is total current assets including cash less by total current liabilities. The result is what is called working capital. It could be positive or negative. In general, if working capital is negative, the company has a problem to run its operation, except for some industries that are acceptable to have negative working capital. That's why banks usually offer working capital loan other than investment loan. Working capital loan will help the company operates business as usual. Imagine if the company only has investment. It has machine on factory but cannot be operated because the company cannot pay electricity and wages. Now, we will connect working capital with cash flow. I will use cash in and cash out logic so you can better understand working capital placement on cash flow. At first, on cash in section. Cash that we have from sales revenue, some part of it must be paid to supplier. Because we withhold the payment, our payable increase. On the other hand, our cash will increase also. That's why if we increase our payables, it becomes cash in, although the cash not directly from supplier. Next, if our receivable have decreased, it means our receivable to customer has been collected. Therefore, cash in to the company. And if our inventories have decreased, it means more of our products on warehouse has been sold. Therefore, cash in to the company. Next, we move to the cash out section. If our payables has decreased, it means we use our cash to pay the loan or cash out. If our receivable have increased, it means more of our customers prefer to buy our products but pay later. Therefore, our cash will be decreasing. I will give you example so you can better understand this. Say, last year we sold our product at $1,000, but some customers prefer to pay later, which amounted to $100. So the remaining cash we had were $900. This year we sell at $1,000 also, but receivable from customers amounted to $500. As a result, we only have cash of $500. As you can see, our cash has decreased and looks like cash out. Although we are not directly give the cash to customers because we still have to produce for the next year. So we have to pay to suppliers, employee, and so on. Therefore, the production costs that's supposed to be paid from customers' payment are billed by company's cash. It becomes clear now why increase in receivable is a cash out for the company. And the last one, if inventories have increased because we buy more, therefore cash out for the company. Next, we will try to make cash flow outline with working capital into it. First, we recapture previous cash flow outline. Cash in, which comes from sales and so on, we put it as a group A. Then cash out, which comes from COGS, etc., we put it as group B. And the rest is net cash flow. Now we move to the right side. If we put working capital into cash flow, as you can see in the cash in, other than group A that I mentioned earlier, there are increase in payables, decrease in receivables, and inventories. Also for cash out, other than group B, there are decrease in payables, increase in receivables, and inventories. And at the bottom line is net cash flow. After we fully understand cash flow outline with working capital, now we will rearrange each of the accounts to make standardized cash flow. There is nothing wrong with our previous cash flow outline. Even some companies are still using it. However, it is better if we also know the standardized version. Moreover, it looks more professional when we present the cash flow to external parties, such as bank and investors when we try to raise funds. At first, I show you previous cash flow outline. Do you guys still remember, right? If you forget all of it, you can replay the video again to the previous section. In making standardized cash flow, we categorize source of cash in and cash out based on three groups. Those are cash flow from operation, cash flow from investing, and the last one, cash flow from financing. Now, I will explain each of the group. Cash flow from operation is a cash flow that related with company's business operation. It could be sales revenue, COGS, operating expenses, and tax expenses. Interest expenses and ujrah expenses also must put it in this group. Some people still misplace those accounts and put it in cash flow from financing. The point is, everything that's stated on income statement except depreciation and amortization will also be put in this group. Working capital increase or decrease also must put it in this group because it's still related to company's operation. The second one is cash flow from investing. All of investment are related, whether from fixed asset or intangible asset such as brand or royalty acquisition, must be put in this group. The numbers are negative because the company used the money to invest. If the number become positive, it means the company sell its asset through divestment to get some cash. And for the last group is cash flow from financing. The cash flow related with financing of the company. It could be from paid-in capital and loan. If there are dividends, it must be recorded here as a cash out. Also, if the company want to repay the loan, it must be recorded as a cash out. Interest expenses and ujrah expenses must not put in this group, even seems related with financing, as I explained previously. That's all my explanation of cash flow outline to make simple financial projection. Next, why don't we try it out on Excel? In this last part, we will practice on how to make simple financial projection by using Excel. Now, let we start it. First, we need to make titles. Also, don't forget to specify currency and unit value, whether in US dollar or China yuan, in thousands or full amount. These information are important and cannot be underestimated. The first title is the name of the company. The second one is the project name. In this example, is a hotel project. And the last one, specify unit value and currency used in this projection. First of all, we have to make projection of revenue. Hotel revenue consists of revenue from hotel rooms, foods and beverages, and other revenues. Assumptions that are used in room revenue projection are occupancy rate, operational days in a year, number of rooms, and the last one, average room rate per night. In making projections, we have to determine the time period, whether yearly or monthly, and how long the period is. The time period in a projection also depends on the type of business. In this example, I assume 10 years projection. Direct to the right. For occupancy rate assumption, in the first year, make it low first because the hotel is still new and hasn't gotten many customers yet. Later, occupancy rate will increase every year until peak at 80% and become stable afterwards. Operational days and number of rooms assumption will remain fixed during projection, unless there is hotel development that will increase number of rooms. Room rate is assumed to increase 5% per year. Click F4 button twice to lock column. Direct to the right. calculate room revenue, we multiply all the assumptions that we have made. Click F4 button thrice to lock column. Drag to the right. Click twice to fit column width. Revenue from foods and beverages is assumed from percentage of room revenue. Click F4 button thrice to lock column. Drag to the right. Copy cell format. Other revenues such as from laundry and karaoke is also assumed from percentage of room revenue. Click F4 button thrice to lock column. Drag to the right. Copy cell format. After we have made revenue projection, we sum it all to calculate total revenue. Drag to the right. Click twice to fit column width. Unit value refer to previous cell above. Copy cell format. Unit value and time period refer to previous cell above, So it's easier if you want to change unit and period assumptions. Copy cell format. Next, on cost projection. In this example, on direct costs. Direct cost value assumptions is obtained from percentage of each source of revenue. For example, room cost is obtained from percentage of room revenue, and so on. Click F4 button twice to lock column. Click F4 button twice to lock column. Click F4 button twice to lock column. Drag to the right. Copy cell format. Sum all numbers quickly with AutoSum function. Drag to the right. Next, on investment assumption, which is hotel investment. Unit value refer to previous cell above. Copy cell format. Hotel investment consists of land, building, facilities, and mechanical, electrical fixtures and furnitures. Sum all numbers quickly with AutoSum function. Determine the source of financing and how much each proportion. In property sector, we also need to know how much investment per room, so as to benchmark whether our investment not too expensive. The formula is total investment divided by total rooms. And now we will make working capital assumption. Unit value refer to previous cell above. Copy cell format. Time period refer to previous cell above. Drag to the right. Copy cell format. To calculate receivables, the formula is revenue multiplied by days outstanding divided by number of days in a year. To calculate inventories, the formula is direct cost multiplied by days inventory divided by number of days in a year. To calculate payables, the formula is direct cost multiplied by days outstanding divided by number of days in a year. Next, we will make number of days assumption. How long receivables are collected, how long inventories are stored, and how long payables are paid. Click F4 button twice to lock column. Click F4 button twice to lock column. Click F4 button twice to lock column. Drag to the right. Net working capital is current asset less current liabilities. Increase or decrease on working capital is calculated by value of previous working capital less by value of the period after. If increasing, the result will be negative. On the other hand, if decreasing, then the result will be positive to cash flow. Drag to the right. And the last section, I will make cash flow projection. Unit value refer to previous cell above. Copy cell format. Time period refer to previous cell above. Drag to the right. Copy cell format. On cash flow from operation, cash in from revenue refer to revenue projection above. Also with direct costs refer to cost projection above. Operating costs such as administration expenses are assumed by percentage of revenue. I forgot, cash out must be negative in value. Don't forget to input cost of financing on cash flow from operation, if any. Its existence will depend on maturity of the loan. In this example, the maturity is 10 years. Tax expenses from hotel business are assumed 10% of revenue. Click F4 button twice to lock column. Don't forget to include increase or decrease on working capital that we have made before. Drag to the right. Drag to the right. Sum all numbers quickly with AutoSum function. Drag to the right. Cash flow from investment comes from investment value that we have made previously. In this example, investment is one time only on the first year. No plan to invest more in the future to develop the hotel. On cash flow from financing, long-term debt will be paid in 10 years. The principal payment will be paid fully on maturity or bullet payment. We assume there is no dividend during projection because cash will be prioritized to repay the loan. Sum all numbers quickly with auto-sum function. Drag to the right. Beginning balance is the cash position on the beginning of period. Net cash flow is the remaining cash on that period. Ending cash balance is accumulated cash at the end of period. Drag to the right. Sum all numbers quickly with auto-sum function. Drag to the right. Ending cash balance must be positive or zero and cannot be negative. If happen to be negative, the company must cover those negative cash. Therefore, we need to revise cash flow from financing to add more equity or loan, or even revise working capital to add more accounts payable. If you have not revised yet and the number still negative, the cash flow projection that you made is not correct. As you can see, the ending cash balance is positive during projection. Moreover, ending cash balance at the end of projection still higher than equity injection. Roughly to say, at the end of projection, our investment has a return. Don't forget to hide grid line so it looks clean. Now we will try to adjust print setting because the pages are still a mess. If the printing layout has been set, we are ready to print. That's all from this video. Good luck and see you again in my next video. Wassalamualaikum.